other reasons. And right now we don't really understand what that is, but certainly it seems like people are getting infected in conditions that previously were highly unlikely to mediate infection, and that's fueling this massive surge of cases.
Dr. Patrickoff with the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Checking those vaccine stocks, Pfizer shares up 1.4%. Its German partner BioNTech, its ADRs down 2.1%. AstraZeneca up 1.4%. Moderna now lower by 1.1%. J&J Johnson & Johnson up by 1.4%. Recapping stocks trading mixed, S&P lower by 14 points, down 0.3%. 10-year yield 1.76%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
God, I want to move in that 10-year, the Treasury curve. All right, Charlie, thank you so much. Well, carrot or stick? Citi definitely pulling out the stick today, becoming the first major Wall Street bank to impose a strict COVID-19 vaccine mandate. Man, they are getting tough.
Jenny Serrain has the exclusive. She's finance reporter with Bloomberg News. She's on the phone with us from New York City. Jenny, workers at Citi who don't comply by January 14th to get a shot, what happens?
Yeah, so the mandate actually allows folks to apply for religious or medical exemption. So I think that is an important thing to note with all of this. But yeah, if you don't either apply for that exemption or get the shot itself, then you'll be placed on the unpaid leave, and at the end of the month they will fire you. So definitely a pretty strong message, and something they've been telegraphing since October, trying to get anybody who was hesitant on board, but definitely, taking steps to kind of carry out what it said it would.
Well, and it's interesting. There's a lot going on right now. The U.S. Supreme Court set to hear arguments right today on a Biden administration order for large employers to require vaccinations or weekly COVID tests, meaning more mandates could be coming if the rules proceed. I mean, we're seeing information from the government, mandates come from the government, and companies are probably looking to kind of take steps to potentially comply with maybe possibly what's coming at this point. I am curious I don't know how much you can tell us. How did you find out about this story? Was it somebody who wasn't vaccinated? Somebody who was vaccinated?
Well, I think definitely it's interesting that some, a handful of employees have decided to speak out and go public with their consternation.
Are they vaccinated or not?
I think so.
Yeah, okay, forget it.
I mean, I think a lot of folks it's a very divisive issue.
Yeah.
So Citi has bankers in Manhattan where vaccine hesitancy isn't that high or isn't that, big of an issue, but they have folks in Missouri, they have folks in Kentucky, they have folks in Florida, Texas.
Right.
It's a very hard to have a one-size-fits-all policy, and so you kind of see what has to end up coming with that when you, make a mandate for 70,000 people in many, many states across the country. So it's definitely not something that everyone agreed with, and I think the company has tried its best to do different programs and do lots of education. They brought in doctors. They've, held lots of hands. But I do think it was interesting that, the handful that did kind of spilled out into the public and decided to go this route.
I do wonder, too, though, what about, if they have client meetings, are they going to say, I'm not going to take a meeting with you if you aren't vaccinated? I wonder how widespread something like this goes through a company.
Yeah, I mean, I definitely think certainly in places like New York where, you'd kind of think about bankers flying out to meet clients, it's a much easier mandate to make. But in places like Florida and Texas where you have the governors coming on and saying, no, your company isn't allowed to mandate that you have a vaccine, I think that's a very different type of messaging that, bankers or employees are getting from both their company and their state government. So I think that was kind of the point of the story, was just to show it's not an easy path, and still they've at more than 90% compliance, the figure that's rapidly rising.
So what does this mean for other banks, Jenny?
Well, I think a lot of what other folks are thinking through is hinging on what the Supreme Court decides. So they, started to hear opening arguments today. OSHA has said it will start enforcing starting next week. So I think we're really at this kind of crazy time for HR professionals and these return to office people where they have to start making a call. Are they going to mandate the vaccine? Are they going to implement weekly testing requirements? Are they going to, bring back masks to even sitting at your desk? They really have to make some of these tough calls, because pretty soon they'll start getting, OSHA will start signing them if they don't. So this is just the beginning. I think we're going to see a lot more of this from a lot of different companies. And for those companies like Citi that have folks all over the country, it's not an easy path.
Yeah, I do. It'll be interesting next week. As you said, we're going to be hearing from all of the big banks and see what they have to say about certainly COVID and some of their policies following on this Citi news. Jenny, thank you so much. Really appreciate it. Jenny Serrain, finance reporter at Bloomberg News, on the phone in New York City. Her story, it is the most read on the Bloomberg terminal in the past 8 hours. But again, you're seeing companies at this point, here we are, in our third year, taking policies and taking steps to be able to really open up their companies.
I anticipate we're going to see more of this, not just from banks, but from other big companies. And I also think that boosters are going to be a big part of this too. How are companies going to incorporate boosters into their policies?
And I feel like I'm going to get ready for a fourth booster, right? Whether it's in 6 months or it's just
Israel's already doing it.
Exactly. All right, our thanks to Jenny. Let's get back to world and national news for that. Back to D.C. and Nancy Lyons. Hey, Nance.
Thanks, Carol. The first black man to win the Oscar for Best Actor has died. The Bahamian Minister of Foreign Affairs confirmed that actor Sidney Poitier has died at the age of 94. He won the Academy Award for Best Actor in a leading role for Lilies of the Field. Poitier also received critical acclaim for playing a black doctor engaged to a white woman in Guess Who's Coming to Dinner, starring opposite Katharine Hepburn.
Dr. Prentice, I'm so pleased to meet you.
I'm pleased to meet you, Mrs. Drayton. I take it Joanna's already busted out with the big news.
Well, she has, told me a good deal, and all very quickly, too.
Poitier died in his native Bahamas, with the deputy prime minister calling him a national treasure. A public memorial service for legendary football coach John Madden will be held next month. The NFL says it'll take place February 15th in Oakland, California. The league says more details will come out later. The 3 white men convicted of killing black jogger Ahmaud Arbery are waiting to receive their sentence. Travis and Greg McMichael, along with Roddy Bryan, all face a minimum of life in prison. Testifying ahead of the judge's decision, Arbery's mother, Wanda Cooper Jones, asked the judge to impose the maximum sentence for all 3.
Ahmaud never said a word to them. He never threatened them. He just wanted to be left alone.
Lawyers for the defendants who planned to appeal their conviction had argued their clients had legal grounds to apprehend Arbery on suspicion of burglary. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Master, Tim Stanovic in our Interactive Broker Studio. We're also, check it out, we're streaming on YouTube. Just search on Bloomberg Global News. Yes, you actually saw this story.
Yeah.
You did. It's a great one.
I think a lot of people think of Steve Schwartzman and think about his birthday bash from a few years ago. The one that got a lot of attention, I believe, was in a New Yorker profile. But it's another great story from our own Amanda Gordon, among the most read on the Bloomberg terminal this afternoon, has to do with Steven Schwartzman canceling his big birthday bash to celebrate his 75th. He, of course, is the founder of Blackstone. He was set to celebrate his 75th birthday next month with a party at his Gilded Age mansion in Newport, Rhode Island, but that's been postponed.
Yeah, that's, what's interesting, I feel like this time around, you and I have discussed this on air, is, again, we know how this can play out. We also know how to maybe put a stop to it or slow the cases and bring those numbers down quickly. And I do feel like people are reacting more quickly. It's also, you don't want to be the one who throws the party, and a lot of people, and Steve, love you, we've talked to you, a little bit older, that these are potentially, even if you're vaccinated, more susceptible. You don't want to be the super spreader event in the Gilded Mansion that we're all talking about in a couple of weeks.
You say that, and I think about CES.
Yeah.
That's happening right now in Las Vegas. And I think about the Grammys that were just postponed as a result of the spread of the Omicron variant. So,
JP Morgan, the
healthcare conference.
Massive conference.
And that was canceled weeks ago.
Correct.
Or moved virtually, I should say.
Which was a shocker.
Online.
It's one of those things that you're like, okay, they're taking it seriously.
Well, that was the day when we started to take it seriously, I think. You and I were here and we were like, okay, something has changed because these companies are not sending their employees physically to be at the JP Morgan healthcare conference.
Meanwhile,
go ahead.
No, I was thinking about Mayor Adams. He's saying, I need my city to be open. And we have seen it firsthand when things shut down. Nobody's in restaurants. It's really quiet. You can breeze through the streets of New York right now.
And look, it's important to note that hospitalizations are not at levels that were feared with other variants and that have been seen with other variants, but that doesn't mean that people aren't changing their behavior as a result of this.
Exactly. And probably we'll see it playing out in our economic statistics in weeks to come. You're listening to Bloomberg Radio.
headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. It is a down day for the S&P. Off-session lows, those gains in financials and energy stocks help counter declines in mega caps. Among some of those energy names right now, ExxonMobil up 0.9%, BP up 2.8%, Chevron higher by 1.6%. Let's begin with crude oil. West Texas Intermediate, though, trading lower by 0.4%, $79.11 a barrel. Gold is up 0.3%, $17.96 the ounce. ounce. Bitcoin down 3.2%, 41,750 on Bitcoin. 10-year yield 1.77%. As I speak, we've got the S&P down 4 now, down 0.1%. Nasdaq down 97, a drop there of 0.6%. The Dow higher by 115 points, up now by 0.3%. Bottom line here, tech woes are deepening on rate concerns. Again, that 10-year 1.77%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. So the new issue of Bloomberg Business Week is out. It's got a great cover on it to match a great cover story on pop star Jessica Simpson. Let's get into the issue, though, now with the magazine editor. We're talking about Joel Weber on the Access line in Brooklyn. I do love the cover image, too.
I do, too. I'm holding it up in my hands right now on the cover, how Jessica Simpson bought her name back. When your billion-dollar empire implodes, you get a loan, go to bankruptcy court, and start over. It does bury the lead, Joel, that this battle really hit hit a high point when she was giving birth.
Yeah, the story opens just an incredibly memorable scene as she's watched this billion-dollar fashion empire that she basically lent her name to, a licensing deal. And it's basically falling apart on her right as she's giving birth in the middle of the pandemic, no less. And so, from there, it's just an utterly gripping beginning of the story about how she, has clawed back a story that I think is a really memorable one. And her business is just getting going with her in charge of it. But it's sort of this amazing thing of normal people, maybe the three of us. I've never thought about losing my name, but that is something that somebody like a Jessica Simpson might have to worry about. And what do you get to do once you get it back and have a business that has your name on it again?
Well, and that's what's interesting about this story. I feel like it's a primer, Joel, in many ways about licensing, right? And celebrities. I guess sometimes we think, oh, they're so in control of their businesses, but so many often license their name out on an array of products, which is the case in what she did. Sometimes it goes really well, sometimes it doesn't.
And that's right. I mean, for her, it actually did go incredibly well for a while. And, it's like, if there's a lesson within the lesson here, it's like, choose your partners wisely. And she did do that. She absolutely did, except that when the first one passed away, it basically set off this domino effect that, she was on the outside looking in. And that's what led her to have to go to bankruptcy court and, reassert herself.
So without giving too much away about the cover story, what's next for Jessica Simpson?
Well, I think she has to actually run a business, and that in and of itself is going to be challenging. But the fact that her mom Tina is very involved and has been for a very long time, actually, that the two of them basically get to recreate that empire, and we can. If everything goes well, you can see how successful it can be from its previous iterations.
Yeah, and I just love all the players that are in the story that really explain how she got to where she was initially, and then those that help bring her down. Let's get to a story that really has stayed with us throughout the week. I know we talked with you about this. COVID reversing 25 years of progress for the world's girls. Where you guys take us, as you in the magazine always so well do, to developing worlds and tell very personal stories of what's happening with women around the world.
Yeah, this is an incredible story that we call the Lost Girls of COVID. And to me, one of the things that has stuck with me about this story is this idea that, look, we're 2 years into this pandemic now, and we've been talking about the head-on consequences for a really long time of just what COVID does to your body and what obviously it's done to society. But there are these other hidden things that I think we're only beginning to appreciate. And that was the case with this story, which is, over the last 25 years and change, we have just seen girls around the world have an amazing ascent. The progress that they've experienced from health to education, it has dramatically put them into positions that they wouldn't have otherwise been in. And that has brought great good to the world. And we've seen economic growth because of that. And this is especially true in the developing world, like you mentioned, Carol. But what COVID has done is actually erased a lot of that progress. And that's where that story goes.
So, again, I'm trying to look forward here and understand how we avoid a situation where it takes 25 years to get girls in the developing world back to where they were in 2020. What do policymakers need to do? What do governments need to do? What do nonprofits and NGOs need to do? How does that happen?
Well, I think we just start by talking about it and acknowledging what a problem it is, and that if we're not aware of it, then a lot of these girls are going to suffer in silence. And the main thing was one of the main things in the story, and which largely is centered in Kenya, right? Is this idea around teenage pregnancies, right? That the moment that a girl has to start caring for a child, it basically derails what other progress was being made. But that is not like an insurmountable hurdle, But it does mean that policymakers need to be able to support young mothers with the resources that can help them succeed too. So that strikes me as like one place that can go. But boy, there's a lot of others. And as long as we're not blind to it, and that was sort of our goal with the story, was just to be talking about what a significant challenge awaits these women.
Yeah, substantial setbacks for these girls in the developing world. Not apples to apples, Joel, but certainly another story that deals with setback potentially for women, and this has to be kind of the aftermath of Elizabeth Holmes and Theranos. Like, what have we learned? And you actually asked that of Ashley Vance.
Yeah, when the headline crossed my email that the jury had reached a verdict and had found Holmes guilty on several counts, I immediately just was like, Ashley, what does this mean? And it had stuck with me, especially just not that long ago, a couple months ago, we did that cover story about 23andMe, which very similar sort of story, right? You have a female founder in the biotech space, doing, venture backed for a long time. Her story, the company becomes public, but it just struck me in working on that cover story how much of a challenge it must be to be a woman doing all that stuff and then have the Elizabeth Holmes narrative in the background. And Ashley and I were talking about that, and he said, you know what, don't, and this is what he writes in the story, don't read into that so much. The Holmes story, the outcome is that fraud is fraud, and at the end of the day, that was what a jury found, is like, so don't go thinking that there's some greater meaning to Elizabeth Holmes, so much as like, look, fraud is fraud, and this is America, and we have a legal system that thankfully can step in and expose that.
Well, Joel, just in the last 30 seconds that we have, the pushback to that has been that, Silicon Valley culture is fake it till you make it, right?
Yes, and that is totally true. And, there will be the lesson of Theranos, which is Theranos was fraud, right? And that they had technology that was unproven. There's a lot of other really promising ones out there. And I got to say, look, bring it back to COVID. Who thought that we would have mRNA vaccines in the time frame that we've had them? Like, this has been an amazing accomplishment, and let's say that there's not going to be many more of those in biotech in the years to come.
All right, Joel Weber, thank you so much. Editor of Bloomberg Businessweek. Check out the new issue. It is on newsstands, online at BloombergBusinessweek.com, also on the Bloomberg Terminal. Also a fun section about where to go in 2022. We talk about some of that with Chris Rouser on our weekend show. Catch that on Bloomberg Radio.
to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. With 60 minutes left in the trading day, the trading week. Caroline Hyde, Romaine Bostic, Taylor Riggs, of course, joined by our colleagues Carol Massa, Tim Stenovic. We are bringing together all of our audiences, TV, radio, YouTube, to dissect what has been, well, a pretty torrid time in big tech, down more than 4% on the week.
Yeah, really tough week. There's two stories, right? It's the sell-off that we've seen in the technology sector and the move up that we've seen in rates, Tim. That's really been those guiding two market stories.
Yeah, it's so interesting, Caroline, that you mentioned that. I'm watching shares of ARK Innovation ETF, the so-called disruptive technology from Cathie Wood, down this week by more than 10%.
Oof, let's have a look at the slightly mediocre moves on the end of the week. They're not as gargantuan as we'd seen previously on the Tuesdays and the Wednesdays, but we're currently off by 0.6% on the NASDAQ. So once again, falling. Volume's actually a little bit lighter here on the NASDAQ, but it is down to the tune of 4.2% on the week. That is the worst week since February 2021. We currently see the Dow Jones off by 0.3%, 119, actually up 0.3%. So your outperformer is once again the Dow, 36,355. On the downside, though, remains the S&P 500 down by 0.1%. That's 4,691. The Russell, also a key underperformer on the day, down 0.8%.
And I am a total broken record as well, because 5 days now a trend does make as we start the year. Take a look at where we are on a sector level, you guys, for the day. Energy, financials, again, some of the top two best performers are up 1.2 to 1.4% on each of those indices. And down at the bottom, again, it's real estate, communication, and tech. And technology really has been, Romaine, the big draggard all this week, particularly on a day like today, again off about 0.5%.
All right, well, let's cherry pick one of those tech stocks and take a look at Netflix. It's down for a sixth straight day here. You're actually down about 21% right now from that all-time high that it reached back in November 17th with regards to Netflix. And those shares continue to move lower here. And then you got Discovery here, which I thought was interesting because it's sort of also in the streaming space. I mean, you know, it has HGTV, which is one of my favorites. It has Animal Planet, which I know is one of Taylor's favorite, and Eurosport, which I'm sure is Caroline's favorite as well. And you remember this stock collapsed back in March and April. Remember, it just absolutely collapsed back in March and April, and it was below that 200-day moving average all the way back going to May. It finally poked above that today, up 16% here on the day. There's a lot of optimism, and it's not just Discovery. We heard from AT&T, gave out some numbers on HBO Max, as well as Viacom on its streaming services. So some of these sort of second and third tier streaming services really seem to be picking up steam, but we have to, though, bring it back to rates. Of course, bank stocks will be in focus, and I kind of missed this earlier this week, but home builder stocks have really taken on the chin, which I guess makes sense when you look at where rates have gone, guys, over the last few days.
Mortgage rates ticking up, but look at where the yields have done so on the 10-year. On, in general, a huge move, rate of change kind of move, as Taylor would say. We are having the worst week for the 10-year since back to June 2020. So significant push higher. But the 5-year as well, just, I mean, the worst start to the year for the 5-year Treasury since almost 2 decades. So significant moves, Carol.
That's the belly of the curve.
That is the belly.
Belly of the curve. All right, so taking a look at the jobs report, of course, it's been all about that. And it was an interesting report, that headline number, right? That non-farm, really kind of the one negative aspect of it. But everybody seems to be increasingly, what?
Was that negative, though?
Well, disappointing.
It was a big miss.
It was a big miss,
It was
right?
a miss, yeah.
But there are, everybody coming out, there's seasonal variations, perhaps. And it does feel like, and this is what I was going to get to, is that it does feel like people are looking through it and seeing all of the positive aspects of it, including the U.S. Labor Secretary. Here's what he had to say on Bloomberg Radio and Bloomberg TV earlier. We're talking about Marty Walsh.
We're seeing lots of positive signs. We know in 2022 we still are living within the pandemic, so we have work to do as we move forward. You mentioned inflation. The president is focused on bringing inflation down. The president's economic policies continue to work. We're going to continue to move forward here in 2022 to make sure we get Americans back to work.
And of course, that is the U.S. Labor Secretary, Marty Walsh. You know, it's funny, Romaine, you bring up a good point. Carl Riccadonna was saying, 200,000 a few years ago, we would have been like, great jobs number, great non-farm payrolls number, but we are certainly in a different environment.
Yeah, and of course, we know the administration is going to take a victory lap. They've sort of been pointing out the 6+ million jobs that were, I guess, created. I don't really like that word because it really wasn't created. It was more kind of recouping what was lost. And it's understandable why they would take a victory lap. I thought it was interesting, though, that people seem to be either downplaying playing or overlooking two things. The fact that we saw wages go up on a year-over-year basis by about like 4.7%, and the idea that that employment rate ticked down pretty significantly overall, but you still saw certain segments within that employment picture, i.e. black people, including black women, that employment rate go up.
Right. Yeah, look, that's a really, really important point, and I think it's important to note from this jobs report. We spoke to Bethy Frankowitz over at Manpower Group a little earlier. She made the point that there are still way too many people on the sidelines right now that are not coming into the labor force. What's going to get them back into the labor force? We have seen wages go up to a certain extent, especially among some groups of people, but still not enough to get everybody back into the labor force.
Yeah, hey, the bankers keep getting bonuses, so according to Bank of America. But what about everyone else? Diane Swank is going to be joining us on What You Missed a little bit later. We're going to focus on entirely with an issue that Romain points out. This is still an unequal recovery. This is not equality and inclusive labor force. What happened to that point from Fed Chair Powell? I thought that was the key driving force, but no, inflation takes the helm right now.
But this is the thing I wonder, and I wonder how much this is going to come up at his confirmation hearing next week, is inflation that out of control where he has to completely sort of push to the side some of that commentary that he did make about the job market and the idea of having a more equal economic recovery?
Well, Ellen Zentner out with a note again today from Morgan Stanley saying that CPI data next week is going to show inflation going from 6.8% to 7.1%. So it isn't getting better. Rick Reeder of BlackRock saying the Fed is definitely behind the curve. And so those are the comments that perhaps this chairman, and we'll get comments from him Tuesday, I think, during his confirmation hearing, and we'll see how he tap dances that.
Yeah, exactly, how he tap dances. But I also do wonder how much he says, does he give us any indication in terms of timing of when inflation may peak? And this is where we have to get an idea. We know it stayed longer than everybody thought it would remain, but nonetheless, do we start to see, we've heard supply chain problems easing, so do we see, the end in sight?
But the answer to your question is what is he looking at? Right? Because the whole admission about this not being transitory was by his own admission that the Fed was looking at the wrong thing, or they were at least not paying attention to other aspects of inflation, and that was why, at least the interpretation, that's why they were behind the curve.
Energy is coming down, but everything else doesn't seem to be coming down, at least at the rate in which he thought it was.
Energy is such a great point because this is a global theme. Look, at the end, the numbers coming out in terms of inflation out of Europe today, the ECB, that is ugly reading for them when you see inflation above 5%. But you strip out energy, you strip out food costs, and actually the more normalized version of inflation isn't that high. It's interesting as to once you peel away how much of these inflationary pressures, where are they coming from, and how important does energy
Should you be stripping that out, though? Because for people at the lower end of the income spectrum, energy and food is like the bulk of their purchases.
And how transitory, though, therefore, is that? And, well, in Europe, Russia just needs to start pumping a little bit more, and maybe the pressures come down a little bit.
Oh, all right. Do you think Putin watches?
Yes, very powerful watches.
All right, to be continued, folks. We're going to join you again live on radio, TV, and YouTube. Of course, we'll go beyond the bell, wrap up the markets for the day and the week. Join us again at 4 p.m. Wall Street time for today's market close.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, folks, you are listening to Bloomberg Business Week. Carol Masser along with Tim Stenovic and our team there, Caroline, Taylor, and Romain on TV. Jobs report. I mean, most people are saying this ticks the box for the Fed to start raising rates. Maybe it's March, maybe it's May. It's just a matter of time.
I got a question for you.
Sure.
I don't think you're going to be able to answer it.
Okay.
But here's a question that I've been asking myself
Thanks for the support, buddy.
Today. Well, how do economists keep getting that headline number so wrong?
Well, first of all, what do you mean in terms of the non-farm?
Yeah, so 199. It's a great. It was a great number a couple of years ago, but the survey of economists surveyed by Bloomberg said that it would be 450,000 new jobs added. Another huge miss to the downside, but it's still a number that is really good for all intents and purposes.
There is so much that we don't know about coming out of this cycle. First of all, the magnitude of the stimulus that has been pumped into the economy, right? Yeah. So we have never seen in our lifetime the economy shut down and then bouncing back as quickly as it did. I mean, I've heard people, just talk about these numbers and the erratic. We understand why they were that way, but what does it mean as we get on the other side of this? I don't know as the Fed pulls back on all of this massive monetary stimulus, so much more than that we got during the financial crisis. How does it play out? I don't know. Sorry. For someone who doesn't know.
We'll find out next week, at least with some new data.
All right, let's get back to world and national news. She knows a lot when it comes to all of that. She is Nancy Lyons in D.C. Hey, Nance.
I'm not sure about that, but thanks, Carol. We're just getting this in. The 3 men convicted of murdering Ahmaud Arbery as he ran through a Georgia neighborhood have been sentenced. Travis McMichael, who actually shot Arbery, received life in prison without parole. His father also received life without the possibility of parole. And William Roddy Bryan, who videotaped the incident, received life in prison, but he does have the chance of parole. Arbery's mother had asked the judge to impose the maximum of life without parole for all 3. The Supreme Court is being asked to stop the Biden administration from requiring vaccinations or mask and testing in companies with 100 or more workers. Bloomberg's Irv Chapman with more.
Justice Elena Kagan said workers are dying of COVID every day.
The agency has done everything but stand on its head to show quite clearly that no other policy will prevent sickness and death to anywhere like the degree this one will.
Chief Justice John Roberts.
It sounds like the sort of thing that states will be responding to or should be, and that Congress should be responding to or should be.
Justice Samuel Alito referred to the right of workers to make individual decisions on the risks and benefits of vaccination. In Washington, Irv Chapman, Bloomberg Radio.
President Biden has spoken about the jobs report showing employers adding 199,000 jobs last month, less than expected, but it also showed the unemployment rate down by 3.9%. He fired back at Republicans for being critical of the economy.
They want to talk down the recovery because they voted against the legislation that made it happen.
Biden is now heading off to Colorado to survey wildfire damage. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Nancy Lyons.
All right, Nancy Lyons, thank you so much. Carol Masser, Tim Stenovic in our Interactive Brokers studio, streaming on YouTube. This headline just crossed about 20 minutes ago, 30 minutes ago. I think Caroline Hyde mentioning it when we were checking in with our TV team on the markets. Bank of America.
Yeah, the company sweetening bonuses to make up for its restraint last year. The firm is planning to increase rewards for bankers by more than 40%, Carol.
Yeah, that's pretty, that's not too shabby. It's an exclusive by our Bloomberg News team, Kat Doherty, putting it out. So telling its haul from a second banner year for Wall Street securities firm and shifting its philosophy on bonuses, dramatically sweetening, as you mentioned. And those bonuses could rise by an average of more than 30%, at least according to, I guess, someone or some of the people briefed on the discussions. And when it is as much as 30%, we're talking about sales and trading operations. That's where you could see it.
So here's a really interesting nugget from Kat Doherty's piece. It means that rewards may climb even faster than some units' annual revenue growth, and in some cases, even if revenue slipped, a break with the industry's typical practice. Here's the reason. Executives are considering how businesses performed over the past 2 years, an era in which many achieved earnings significantly higher than pre-pandemic levels.
It's fun to watch the different firms, because if you remember, Goldman last year, JP Morgan bumped up their bonuses for 2020, and it left B of A, that wasn't actually last year, that was 2020, B of A kind of all that more vulnerable when it came to poaching talent. And this is some of what it's about, right? Holding onto your talent, not letting them go, especially if you've got some decent earners or generators in terms of revenue. And it costs you something when you lose an individual at your firm.
And how much of this is about poaching from bank to bank versus poaching from banks to PE versus banks and bankers and engineers from those banks going to tech?
Yeah, exactly. So we're going to be hearing probably a lot about this. At the end of the year, that's when we get all this information. We're also going to get the big banks reporting. B of A reports on January 19th, so maybe getting out ahead, or, well, this was an exclusive, so maybe they didn't want it out ahead.
Well, it's out now.
All right, everyone. You are listening to Bloomberg Business Week. Carol Masser, Tim Stanovic. Those bank names, by the way, they're on a tear this week. The KBW index up about 10%. This is Bloomberg.
facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pell. Another tough day for techs. The Dow higher, S&P, NASDAQ, they are both lower. Let's head right over to the First Word breaking news desk for today's afternoon call with all the details. Here he is, Bill Maloney.
And good afternoon, Charlotte. U.S. stocks mixed in a somewhat quiet tape today. The Dow is currently higher by 93 points. S&Ps are down 8. And like you said, NASDAQ under pressure again, down 103. The U.S. 10-year yield at 1.76%. Gold is up 6. And Bitcoin is down by 3%. Among the main 11 S&P sectors, leaders were energy and the financials. Consumer discretionary was under pressure. And leaders said the upside in the Dow, Walgreens, Honeywell, and Boeing, while Home Depot and Nike led to the downside. In other news, South African researchers said that the Omicron mutation may mark the end of the pandemic. The U.S. 10-year yield rose to the highest since January of 2020, and Citigroup to fire vaccine holdouts this month in a strict U.S. mandate. Live from the First Word breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill. Have a great weekend. And to hear live breaking news over your Bloomberg type squawk, SQUAWK on your terminal. I'm Charlie Pellett. That is a Bloomberg Business Flash.
All right, Charlie, thanks so much. Really looking forward to our next guest. He was a former software engineer at Airbnb, taught a class in cryptocurrencies, also a world-class professional poker player, has written a book about it, The Philosophy of Poker. And we're going to do our weekly check on cryptocurrencies. I feel like there's lots to talk about with him.
Hasib Qureshi is managing director at Dragonfly Capital. $1.9 billion in assets under management. Hasib, thanks so much for joining us on the program. You're joining us from San Francisco.
Thanks for having me.
How are you?
I'm doing great. It's a little bit rainy day here in SF, but otherwise doing good.
Well, the data is still coming in for venture capital deals for 2021, but it looks like it's going to be another banner year when it comes to money that's raised, especially a banner year coming for new crypto and blockchain, NFT, metaverse startups. Give us an idea of what 2022 has in store.
So I think what you're probably going to see over 2022 is it's time to put up or shut up for a lot of the metaverse and gaming stuff. So what you're seeing right now, it's a very, very frothy market. We're seeing a lot of excitement around, to be honest, games that haven't really shipped products quite yet. The question is going to be largely, one, are we going to see traditional gaming studios getting into the space, and who is it going to be? Is it going to be the crypto native firms that build these kind of metaverse, NFT, gaming integrated universes, or is it going to be traditional gaming studios that work their way into crypto gaming and crypto enabled gaming? And is that going to be where the lion's share of the market goes? Right now, I think everyone realizes that this is going to be a very important sector. The thing that no one knows is how it's going to play out and how long it's going to take for stuff to get realized.
Well, it's funny because the second half of 2021, if we think about the metaverse and the conversation around the metaverse, I think a lot of the conversation has been dominated by Facebook's name change to Meta and them going all in on the metaverse. I'm wondering who you think are going to be the big winners when we think about the metaverse. Is Facebook going to be able to pull it off, or are startups going to be able to compete with Facebook?
It's funny because the term metaverse has gotten so corrupted over the last year. I think largely as a result of Facebook getting into this and everyone kind of redefining what metaverse means for themselves. Originally the concept of the metaverse implied a digital space that allowed you to connect to many different universes simultaneously. And the entire idea of Facebook owning the metaverse is almost like the idea of Facebook being the internet, which is, kind of, at this point, and for most of us, that's an absurd proposition. So to me, I think it's very clear that Facebook is going to create a very big digital space, and they're going to do everything they can to try to get as many of their users, especially on the younger side, to engage with the kind of social tools that Facebook is going to try to create. But at the end of the day, the concept of the metaverse is this concept that it's going to be an open, extensible platform that many different players are going to be contributing to, not just Facebook/Meta. And so I think in the short run, Facebook is going to be doing a lot to contribute to the infrastructure, the acceleration of augmented reality, and all these different technologies that we need for a metaverse-like interaction to be fully immersive. But in the long run, I believe in the decentralized movement. I believe in crypto, and part of what makes crypto so powerful is the fact that you have so many individual actors and companies contributing to make this overall tapestry of what crypto is. And I think in the long run, the metaverse is going to be the same way.
So I'm curious to talk to us a little bit about Dragonfly Capital, because from what I understand, you guys, are allocating money, making investments in areas that you find interesting, particularly it feels like in the blockchain. But fill us in if you would.
Yeah, so Dragonfly, we're a global crypto fund. We have folks all over the world, in Asia, in the U.S., West Coast, East Coast. We kind of cover everything. We're very early stage investors. We've been early investors into DeFi, into Layer 1 cryptocurrencies. Obviously we're early investors into Bitcoin and Ether and kind of everything under the sun. We anything that's crypto, we touch it. So we're part of what makes us different is that we're very technology oriented.
Yeah.
And we only do crypto. So we don't do fintech adjacent plays or anything like that. Crypto is what we do from day one, and we've managed to become quite good at it.
Well, what are your I'm curious how I feel like 2021 was a big year for cryptocurrencies. How do you see 2022? What might be some interesting benchmarks that, Haseeb, you think we need to be focusing on?
It's a good question. I mean, clearly you can see from the jitters that we've had over the last 36 hours is that the Fed has a lot to say about how crypto is going to evolve over the next year. And ultimately, crypto really rose to the forefront of everyone's attention last year for a confluence of reasons. A lot of them accelerated by COVID, some of them monetary policy more generally. It's certainly the case that crypto was born in the wake of the great financial crisis. Literally in the genesis block of Bitcoin, the very first block of Bitcoin that Satoshi mined, it says, Chancellor on the brink of the bailout for the banks, which is a reference to the original bailout that was happening in the UK, where potentially Satoshi might have been paying attention to. And Bitcoin really came to the fore now in this financial crisis that emerged as a result of COVID. Now, the change in the policy of the Fed and other central banks around the world and the rising of interest rates is naturally going to have an effect on crypto, because crypto, for most of the institutional investors who've gotten into crypto over the last year, who've driven most of this market, they're very, very, the way that they view crypto is much like a growth asset.
Yeah.
And anytime that you're investing in a growth asset, we've seen growth assets really retrace over the last 6 months.
Right.
And I think you're likely to see the same thing happen to crypto if interest rates rise faster than otherwise expected. But in the long term, I think everyone at this point realizes crypto's here to stay. This is not a trend that's going to get reversed. This is not something you can put back into the box. There are some countries that are going to fight crypto.
Right.
But at the end of the day, this is a global phenomenon, and you're not going to be able to turn back the dial of history. The
conversation around it has certainly definitely evolved. Hopefully you'll come back and we can talk some more, because I've got to say, everybody check out his website to understand a little bit more about Haseeb's personal path, because it's a really interesting one. Haseeb Qureshi over at Dragonfly Capital right here on Bloomberg.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week. Carol Massar, along with Tim Stanovic in our Interactive Brokers studio. You were talking about the chart of the day.
Yeah, I'm excited to talk about this one. Crude Oil is going to be joining us in just a minute. We're going to talk a little bit about wages. Yeah, looking forward to it.
Kind of a topical thing.
Yeah, it really is.
All right, first up, back to Charlie Pellet with a check on that trading day. Charlie, 29 minutes to wrap up. What a week.
What a week, and it's only the first trading week of the brand new year. Right now, we have got the S&P trading lower by 6 points. We are on track for a losing week here. Down now by 0.1%. The Dow holding on to gains, been green all day long, up now by 97, higher by 0.3%. The selling in tech stocks continues today. The Nasdaq 100 index down 0.7%. Nasdaq Composite index down 0.6%. Nasdaq lower by 95. 10-year yield 1.76% right now. 10-year down 12.30 seconds. Spot gold up 0.2%, 17.95 the ounce. And West Texas Intermediate crude down 0.6%, 78.99 a barrel. Briefly, Bitcoin down by 3.1% right now, 41,775. Sources tell Bloomberg Reddit, the social media company that helped fuel 2021's meme stock frenzy, is working with Morgan Stanley and Goldman Sachs to go public as soon as March. So certainly a story we're keeping an eye on. President Biden says surging COVID-19 cases will not be the new normal, though the virus is likely to endure and can be managed with newly developed tools. Now, interviewed before the president spoke, Dr. Andrew Patrickoff, a professor of molecular microbiology and immunology at the Johns Hopkins Bloomberg School of Public Health, said while we are making progress, certainly COVID-19 will not be going away.
I do firmly feel we're on a path to make this disease caused by this virus much more mild, much more contained, because we will have population immunity. We will have vaccines that are effectively knocking down severe disease, and we'll eventually have antivirals that are distributed to help limit that. So there are ways that we can control this disease, but this virus will be around for a long time, and it's looking more and more like we're going to have to deal with this like we deal with seasonal influenza.
And Dr. Patrickoff is with the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Checking some of the vaccine stocks that we check every day at this time. Pfizer up 1.3%. Its German partner BioNTech, its ADRs down 1.6%. AstraZeneca's ADRs up 1.3%. Moderna out of Cambridge down 0.8%. J&J up by 1.3%. Recapping 10-year yield 1.76%. S&P down 11, down 0.3. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, let's bring in Kriti Gupta, Bloomberg Markets correspondent for Bloomberg News. She joins us, as she does each and every day at this time, with her chart of the day. Kriti, I love this chart because we're actually talking about Walmart pulling away healthcare workers earlier in the show today, a story by John Tozzi, among the most read on the Bloomberg terminal. You're also looking at wages in the context of Walmart. What's going on?
Yeah, well, I love the story of Walmart, not just because I grew up about 10 minutes away from a Walmart supercenter and I continue to shop there, but because...
Doesn't like 90% of the world, of the country, live within 10 minutes of a Walmart? Of a Walmart? There's some stat there.
Is there? I had no
not
idea.
Not supercenter, but some stat. I'll find it.
Oh, okay. Noted. Well, it's also the biggest employer of the United States. It employs about, I think, 1.6 million people. What's interesting to me about that is that Walmart has also come under a lot of scrutiny for just how much it pays its workers, and that's an issue that it really predates the pandemic, and it's kind of been exacerbated during the pandemic, this idea that wage increases are on everyone's mind, but it's also extremely important for the folks that are kind of in that lower income bracket, especially because for a lot of their inflation increases, they're living paycheck to paycheck. So Walmart was kind of this case study that I really like to look at for this broader chart of the day, which really shows the average hourly earnings for payrolls, which of course it is payrolls Friday. So payrolls minus the costs or hourly earnings of people who are in management roles or non-management roles, I should say. So really the difference between, say, everyone making these kind of hourly increases versus just that lower sector. And that spread is actually very high and increasing more and more. It really tells you here that a lot of the ways that employers, including Walmart, Costco, Target, are looking to hire is by hiking up those rates. So about a year ago, Walmart's hourly wage, for example, was about $14 an hour. Now it's $16.40. For some supercenters, it's as high as $17. When I was growing up, the Walmart wage was about $6 an hour. So it really tells you here just how desperate employers are to get that help, and they're willing to pay top dollar for it.
All right, so Creedy, I am the queen of, so tell me why I care. So tell me I think about somebody listening, and it certainly increases labor costs for companies and stuff, but it also increases the living wages. What was the term that Becky, did she say it wasn't a living wage? What did
no,
she
it wasn't
say?
living wage. It was the full employment is the wrong term to use now. We need to look at the portion of the population that is working.
Right, exactly. And but finally we're seeing employees to some extent in the driver's seat and finally getting paid, a little bit more. But tell me, I'm thinking about our audience who's listening, Creedy, why do you think a smart investor needs to be wary about this or be aware of this?
Yeah, well, this really has to do with a lot of the issues that the COVID-19 pandemic has really exacerbated, and one of them is simply wealth inequality. And right now, a lot of the conversation is about salaries, wages, whether you make it on an hourly basis or yearly basis, catching up or keeping up with inflationary pressures. And the folks that are most impacted by it are the people at the very bottom of the pay scale. But if you actually look at the way employers like Walmart, like Target, like Costco are really dealing with this, it's pushing their real wages, essentially their inflation-adjusted wages, higher than even inflation. So they're actually making more even though you account for inflation. You can't say that about the middle income workers or even higher income workers who aren't living on an hourly wage.
Yeah, there is certainly a gap between hourly and what you would say is salary workers that we're seeing, unless you're working on Wall Street and you're getting bonus. But that's not salary, that's bonus.
Right, that is a really good point.
One time, right?
Hey, I want to make a hard pivot here because I want to make sure we have time to get to the story that caught Creedy's eye today. It has to do with a little meme stock called GameStop. Why are you obsessed with this story too, Creedy?
Because I thought we had left the meme stock frenzy in the rearview mirror in 2021, and we didn't. And I'm having some very important deja vu here because at the start of 2021, we were dealing with GameStop, with AMC, with this crypto surge. In 2022, it kind of seems like it's coming back, this time at least on fundamentals. GameStop really kind of entering the foray of the crypto universe, building an online marketplace for NFTs, for cryptos, for crypto partnerships. And remember, this comes after their bottom line has been under a lot of pressure and their stock has been pretty volatile. So now you actually see those shares soaring quite a bit today to the tune of, 4% now, but as high as 19% earlier.
Yeah, they really, I would just argue that getting into the business of NFTs, is that really fundamental? Like, stay tuned.
Carol, that's pre-2021 meme stock question right there, okay?
All right, Creedy Gupta, have a good weekend.
Let's check the latest world and national news with Nancy Lyons in Washington, D.C. Hey, Nance.
Hey, Tim. It'll be life in prison for all three white men convicted of murdering black jogger Ahmaud Arbery. Judge Timothy Walmsley says Travis and Greg McMichael will not have the chance for parole, while the man who taped the incident, William Roddy Bryant, will have that opportunity. Walmsley said it was clear the McMichaels showed no remorse for what they'd done.
After Ahmaud Arbery fell, the McMichaels turned their backs. It's, again, a disturbing image, and they walked away. This was a killing. It was callous, and it occurred, as far as the court is concerned, based upon the evidence, because confrontation was being sought.
Walmsley says the men clearly took the law into their own hands. All three have appealed their conviction. The White House is reportedly working up a request for more COVID-related health spending. We get more on that from Bloomberg's Nathan Hager.
According to the Washington Post, the White House Budget Office is working with the Department of Health and Human Services on a long-term funding proposal. It's expected to ask Congress for tens of billions of dollars with a focus on therapeutics and ramping up vaccine distribution, as well as more funds to assist with global global vaccine efforts. The administration says no formal request is imminent. It says enough funds are in place to deal with the current Omicron surge. In Washington, I'm Nathan Hager, Bloomberg Radio.
House Speaker Nancy Pelosi has invited President Biden to give his first State of the Union address March 1st. Biden did speak before a joint session of Congress in April of last year, but this would be his first formal State of the Union address. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
So there have been a lot of trends. Thank you, Nance, first of all. A lot of trends when it comes to what's going on in the investing world. We've talked about SPACs over the last year, certainly in the crypto world. And then it has to do with a songwriter's catalog.
Okay, so what do Bob Dylan, Stevie Nicks, Neil Young, Bruce Springsteen all have in common?
They've sold their music catalog.
We can add one more name to that list.
Which is?
John Legend. And you know what's different about John Legend?
What? He's young, isn't he?
He's young, exactly. That's what's so different. He's in his 40s. He's 43 years old, which is obviously a big age gap between Bruce Springsteen, Bob Dylan, Neil Young, and
do we know how
John
much he
Legend.
got?
We don't know how much he got.
Yeah, I mean, it's interesting. Well, the markets are an interesting thing. You see how the crypto world is changing maybe investable assets in terms of NFTs and other things, but we've increasingly seen a songwriter, right? Those are valuable properties, but then selling them to someone.
Yeah, so let's talk a little bit about this deal. He sold both the copyrights as well as the rights to receive royalties from music that he wrote from late 2004 through early last year. That was according to a regulatory filing. An affiliate of the San Francisco-based KKR Credit Advisors, it would be DL Music IPLP, also BMG Rights Management, each purchased a 50% stake in the catalog. Financial terms of the agreement weren't disclosed. I'm eager to know how much.
But that's interesting, too, in terms of licensing. But that's the real value, right? Like, if, the future revenues that are to come in. And it's got to be interesting, I think, about what's the financial model in terms of how you value it. Do you do it based on these older musicians who have a huge, catalog and they've been around for a long time? I don't know. How do you value it?
Well, let's talk about some of those other valuations. Bruce Springsteen's sale of his entire recorded music and songwriting catalogs, that wwent for a reported $500 million.
That's a lot of money.
Yeah.
That's a lot of money. And that, I would say, would be a little bit of an anomaly, don't you think?
Yeah.
Safe to say? In terms of the size of it, and he's iconic.
Yeah. It's amazing that John Legend is 43 years old and made a move like this.
So what does he do now? Does he buy crypto?
I guess if he
assets?
writes more songs, it's different.
This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. We've got 13 minutes to go ahead of the closing bell. S&P poised for the worst start to a year since 2016. Stocks lower amid concern the Fed will be forced to raise rates faster than some investors had anticipated. Right now, the S&P is down 8 points on this Jobs Friday, down 0.2%. The Dow holding on to a gain, up 74 right now, up by 0.2%. The Dow has been higher for most of the session. NASDAQ, though, lower. The tech selling continues today. NASDAQ down 111, down 0.7%. The NASDAQ 100 index down 0.9%. Russell 2000 also down 0.9%. Dow Transports down by 0.2%. And very briefly, the stocks, that is the Philadelphia Stock Exchange's Semiconductor Stock Index, lower now by 2.7%. 10-year news making news today, 1.76% right now. 10-year down 13.30 seconds. Spot gold up 0.2%, $17.94 the ounce. Bitcoin dropping 2.8%, 41,925. And crude down 0.5%. West Texas Intermediate crude 79.05 a barrel. Recapping, stocks are trading mixed. S&P down now by 8, down 0.2%. And that's a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
Back in March, the investment fund, Archegos Capital Management, collapsed after building up vast derivatives bets on several stocks, precipitating billions of dollars in losses for its lenders. The incident raised a troubling question. Why were regulators unaware of such a large concentration of risk until it was too late? Now the Securities and Exchange Commission has a plan to ensure such dangers don't go unnoticed again. Its proposal is simple. Extend disclosure requirements to derivatives. Specifically, if an exposure is large enough, it would need to be publicly reported within 1 business day. This would allow both regulators and the public to see such concentrations of risk as they build. To be sure, more must be done to prevent a repeat of the Archegos implosion, but the SEC's plan is a good start. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, just got about 10.5 minutes left in today's trading session. Getting ready to wrap up the trading day and the first full trading day of 2022. What a week it's been. Remember, the S&P hit a record on Monday, but we've definitely seen a different trade in those Fed minutes, certainly impacting some of the market psychology, Tim, this week.
Well, let's bring in Cliff Corso, President and Chief Investment Officer at Advisor Asset Management. Cliff joins us on the phone from New York City. Cliff, how are you?
I'm fine. Thanks for having me.
Hey, Cliff, how should our audience digest everything that we've learned this week? As Carol mentioned, the S&P 500 closing at a record on Monday. A strong start to the year. We did get a little bit of a Santa Claus rally those first 2 days, but then the tone really shifted when we got those Fed meetings Wednesday. And then also digesting the jobs report today. How do we bring it all together?
Yeah, I think both of those things tie together nicely because today's job report, where unemployment rate dropped to 3.9%, and very importantly, wages year over year increasing to 4.7%. Those are obviously very strong numbers, and it just puts more fuel in the fire of the debate over is the Fed beginning to fall behind the inflation curve, and what is the implication of that for rates as we move through time. And I think the punchline is that the emergency policy that the Fed is still generally operating under, that's long past its expiry date, and that became very clear today with the jobs report numbers.
One and done. Check the box. So, all right. So is it just a debate of whether does the Fed raise rates come March? Does it do it May? Is it just a matter of the particulars and the timing and how aggressive ultimately the Fed is going forward?
Yeah, I think it's maybe a little less about the exact timing and a little bit more about, are they falling behind the curve here on inflation? And, Fed's got a really tough job here and a tough challenge because I think that, they really clearly want to speed up their reaction function, given inflation figures. We saw that with the pulling forward of the tapering. But they're trying to do this without creating undue volatility like we saw during the taper tantrum of 2013. At the same time, trying to do it without damaging their own credibility into the peak of Omicron. So, if they're too slow, they risk falling behind the curve further and further. If they're too quick, the market's obviously fearful that we're not priced for that.
So connect this.
Sure.
Yeah, Cliff, connect this to 2022 and as far as what we should look at for asset allocation and how our audience should think about investing this year.
Sure, and the zero rate narrative has been such a big part of the return, and so I think what we're seeing in the market, and it's what we've believed for quite a while, is that it's with rates rising, which is our expectation. We think it is time for a leadership shift. We think GDP is going to still be solid and supportive of positive market returns this year, but with a lot more volatility because of the uncertainty around rates and inflation.
Where do you think I'm sorry, go ahead.
I was going to say, we do think value will take the baton of leadership in growth, and particularly low or no earning stocks. That's a really tough story, and narrative story in a rising rate environment.
Why do you think ultimately now is really the time for value? I mean, we've certainly had this discussion with a lot of folks over the last year or so about, okay, it's time for value, it's time for value. We talked about it when tech sold off back in March of 2021, just last year, right? An official 10% correction, yet it came roaring back. Why is now there's something different that it really is the time for value to come back?
Sure. Well, we've been in a very big sawtooth pattern around what's been going on with the variants and COVID, but I think the market is beginning to look through. We don't know everything about where we're headed with this, but we do know a lot more, and we have a lot more tools. So as we move toward this pandemic sawtooth up and down unknown into perhaps endemic, we can get a little bit more predictable, perhaps, about where the economy is headed. And again, our view is somewhere between 3.5%, 4%. That's, obviously that's very solid growth. We do think rates will rise, but our opinion is not so much that it would knock off the growth of the economy. And so you have a very supportive scenario. But as well, given muted returns, rising rates, we think cash flow becomes a lot more important. So we're looking at dividend stocks, dividend payers. If rates are rising and you have no earnings or no cash flow, that's a very sensitive instrument to be owning in a rising rate environment. So we think it now is the time, again, with volatility, and we're not saying you can't see corrections, but we think by the end of the year you would see a positive result in the value sector.
Hey, I want to talk a little more about inflation because that's going to be on everyone's mind certainly next week. CPI figures expected to be 7.1%. When do you think inflation peaks?
Well, that's a great question. It was supposed to have peaked already in the third quarter. Obviously, we're still seeing it climbing, but I think it, clearly a lot of it is, or a big chunk of it is transitory. We don't think we're sticking at 7%. We do have, chip shortages and things of that nature that used car prices that are driving this. But we think it'll be sticky because and maybe in sort of this 3.5% range as it stabilizes because of two key elements that are sticky, which is wages and shelter costs. Both those combined are north of 50% of CPI, and we see very good arguments in both of those areas for inflation to be elevated and sticky for quite a while.
Hey, Cliff, how often does recession come up in your conversation? Well, Ari Jersey of our Bloomberg team talked about it. I mean, 2023, 2024, how often does that come up in your conversations?
Well, it's always part of a potential scenario, but we certainly don't see that in 2022 and into 2023. Again, we view it more as a mid-cycle. We don't see necessarily the broad systemic risks yet building in the economy that would cause a recession. Of course, the obvious risk is if inflation is indeed elevated beyond what we would expect, and the Fed does fall behind the curve, that's a classic recipe for the Fed really slamming the brakes on. But it's a very dovish Fed. We see the term hawkish pivot. But it's a very dovish Fed.
Yeah. I mean,
something that you say, well, you don't use those terms, Carol, but you just remind us over and over again where interest rates are right now and where they're going to be even in a year. It's really low still.
I mean, they can make a 4 quarter-point moves, and we're just up 1%. So
Exactly.
it's still pretty dovish. Cliff Corso, have a good weekend. Stay safe. President and Chief Investment Officer at Advisor Asset Management on the phone in New York City. Just a few minutes left in the trading session. Just down about 14 on the S&P 500. Dow up, Tim? About 28. The NASDAQ really, though, the underperformer here. It is down 126 points.
Yeah, down more than 4%, 4.4% so far this year already.
Yeah, exactly. That's 5 days.
Yeah, 5 days.
All right, folks, that's going to do it. Right now, we're going to join by our Bloomberg TV team for Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and YouTube. We're counting you down to the close on this Friday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell. Here to help take us beyond the bell, it's our global simulcast partners, Tim Stenovic and French fry aficionado Carol Massar, bringing together our Bloomberg television, radio, and YouTube audiences. And Carol, the big superlative today that everyone's going to talk about, and you can make of it what you want.
Yeah.
This is the worst start for the S&P 500 for a year going back to 2016.
And remember, we hit a record on Monday, so kind of crazy what's happened in the first 5 days of the year. We're going to all be eating a lot of French fries over the weekend.
Not crinkle cut.
Not crinkle
The
cut.
amount of social media that I've received on crinkle cut chips is ridiculous.
Exactly, Tim. Are you eating French fries?
Are they pro or
Yeah, I'll
con?
eat French
Sorry,
fries.
fries. Get my semantics right.
I'll eat any
It's
French
comfort
fry.
food. We all need a little bit of comfort food this first week.
Look, that superlative is an important one. Certainly what we've seen in the bond market is an important one. I know this week and today is all about the bond market, but I'm also watching the Philadelphia Semiconductor Stock Exchange, the Philadelphia Stock Exchange Semiconductor Index. The stock's down, look, more than, almost 2.8% right now. It's below its 50-day moving average. If it closes under that level, it would be the first time it's done so since October.
And I know we're watching some of those key technicals as well. Microsoft's another one, Tim, where I know that I'm watching all the 100-day moving averages and then the implications that means for the broader market as well. Romaine, there was an interesting comment. I know we just had Brian Nick of Nuveen on our television program, but he was echoing similar comments from Rick Reeder over at BlackRock, saying that it's been clumsy and difficult by the Fed, and it makes it difficult for these markets. Brace for volatility. That is the volatility that we continue to see this week.
I think going forward, too, the big question is how consistent are they going to be in that message since they've made what has clearly been a pivot from what we were hearing out of them just, 3 or 4 months ago. All right, here are the closing bells here in New York. It is a down day across the board here on a daily basis and on a weekly basis. The Dow Jones Industrial Average, I guess you're going to call that unchanged. It's only down by about 5 points right now, though it's still going to finish the week down here by roughly about 0.3%. The S&P 500 is down about 0.4% today, 19 points, or about 1.9% on a weekly basis. The NASDAQ Composite, that's been your big decliner here, down a percentage point here on this day, on this Friday, and on the week, it's down about 4.5%. And the Russell 2000, which actually tried to hold its own here for a little bit, is going to finish the day down. Let me just see if I can pull up the number here. The Russell 2000 is going to finish the day down by about 1.2% here. And we should point out, as always, this is also going to be down on a weekly basis by about 3%, Carol.
Well, speaking of weekly basis, check out the KBW Bank Index. I mean, the financials, and I know we're going to get into groups and sector movers in just a moment, but that index alone is up more than 10%. 1 week from now, we're going to be talking about the results from J.P. Morgan and a few others of the big bank
Wells Fargo.
Names. Yeah, exactly.
Yeah.
And I think Citigroup also, right?
Yeah.
And so we'll be all over the financials, but they have really had a good start to 2022.
They have, Carol. Take a look. Let's go right there in terms of our sector level banks and dividend financials. You're the second and the third best performers. You're up 1.5% or 1% or so. The only outperformer above that is energy, which is also, I think, up like 10% for the year. If you're just taking a look at the index level of this in the first 5 days, you're up 1.5% or so on the day. You go down to the bottom, and this is, of course, that big technology story, Carol, that we've been talking about, with yields continuing to climb across the curve. It's software services, it's hardware equipment, it's semiconductors and equipment, it's autos and auto components. Those are the sectors that are off 0.3 to about 2.75% on the day.
All right, so let's get to some individual gainers in the Friday trade, and certainly a standout. And Romaine talked about this earlier, some of the media companies, Discovery in particular, up almost 17% in today's session. You did have Jessica Reif Ehrlich over at B of A coming out and talking about that name specifically. She upgraded her recommendation to buy from Nutrien neutral, and she cited the potential merger with Warner Media. She said it's going to create potentially a global media powerhouse driven by creative and content leadership, right? It's all about content leadership, but nonetheless, that's a standout and top in the
If I had
S&P.
told you that Discovery was going to be the best performing stock to start the new year in the S&P 500, you'd be great. And it's not just Discovery. Viacom is something like the third or fourth best performer this week as well.
Yeah, and yesterday we got the news that Viacom, CBS, and AT&T, as you mentioned, I think, exploring options for the CW network, which is it Caroline that's watching that network, or?
The CW, I didn't even know that was still around.
You're going to have to inform me.
Which is maybe why they're offloading it or trying to. Lucid Group, also a top performer, up almost 10% in today's session, top of the NASDAQ 100. You remember on Monday, Green Car Reports named their Lucid Air best car to buy in 2022. Just want to mention the meme stocks, if I can. GameStop, up about 7.3%, up 22% at its highs today.
It's an NFT bump.
Yeah, I guess, right? We saw it move in the after hours yesterday. Somebody was talking about it being a fundamental reason to maybe get into GameStop. But
old school.
Quote unquote fundamental.
When did NFTs become fundamentals? I don't know. Stay tuned.
They're the opposite of fundamentals. They're, they exist.
They're just fun.
You know, Tim and I apparently have an NFT. Somebody made an NFT of us.
They did?
Yeah, I don't think anyone's.
How much did it go for?
No, nobody's bid on it yet. It's gotten one view. Yeah.
All right. Well, we need to make that happen.
All right. Yeah. More details to follow on that. I want to get us back on track and look at some of the stocks that moved lower on the day today. Let's start with Texas Instruments. I talked about the SOX earlier and the hit that the SOX has taken of late, falling below its 50-day moving average. Texas Instruments certainly a part of that, down more than 3.9% today. Citi cutting the recommendation, cutting the price target to $187 from $220, trading at $179 right now. Also, following what happened with T-Mobile today, finishing the day down by more than 5%. RBC Capital Markets is saying that the postpaid phone net additions were about in line with the sell side. Investors, though, have been hoping for more, given the high bar management has set over the years by consistently beating expectations.
Do you think this has something to do with the disappearance of the BlackBerry?
No, I don't think so. Yeah, sorry. RIP to the BlackBerry this week, though only the original BlackBerry operating system. As we all know, Taylor Riggs. Yeah, she has the Android version. She still has that keyboard. She can't get away from it. Hey, Roku, not off to a great start this year, hitting a 52-week low today, down close to 7%. Taking another hit after we learned that Scott Rosenberg, the VP and general manager of the platform business, he's been there since 2012, been at the helm of the platform business since 2017. He's stepping aside a little later this year.
A little bit of executive change. Meanwhile, this stat took me by surprise. The dollar index today off by 0.5%. Worst day for the dollar since August. Even though it actually manages to be slightly higher on the week, that shows you the strength that we had in the US dollar on the back of the yield move. But overall, a story of actually reassessment, the muddying waters that those jobs data painted for us earlier today. Is it a question that the market, the FX market, is worried by the actual level of jobs and the fact that therefore the Fed won't be hiking at some point soon? Because gold seemed to be looking more at the inflation picture. We're seeing, therefore, most things higher against the US dollar. I'm looking at Canadian dollar up by 0.7%. Why? Well, because still we see this bid into crude that has actually had its best, well, it's risen for, I think, about a 6th straight week at the moment. WTI off by 0.6% on the day, but on the week it's still higher. This, as we see the oil supplies be questioned, Kazakhstan is an issue, of course Libya is an issue. There's also whether or not we really trust OPEC Plus promises that they will increase the supplies. We're still questioning demand with Omicron, but zinc off by 0.9%, natural gas getting a lift higher as we have this cold snap. The excitement in my household of the snow this morning was palpable in the East Coast. And I look at sovereign bonds because no excitement there. Across the board, yields go higher. Look at Greece debt up on the 10-year, up 13 basis points. Europe, it seemed, having an inflation issue there too, Taylor.
Mimicking really what we're seeing here in the U.S. as well. Sometimes we do daily yields, sometimes we do weekly yields. I'm also going to verbal out the 2-week yields because take a look at this. This is on the week, but going back 2 weeks, the 10-year yield is up 30 basis points. The 5-year yield is up 25 basis points. This is incredible as you're thinking about really how far and how fast we've come. And Carol, we've talked a lot about this on TV as well. The implications given that the big rise in nominal yields has become higher up in real yields. And that is, well, a little bit of a tightening of the financial conditions. but a growth in some of that growth expectations. This is a higher growth story that is underway and being reflected.
Well, and let's not forget there, and I know we talked about this yesterday, we do know the economy is going to continue growing. There is growth, and maybe it's a different trajectory than what we've seen in the bounce back from the pandemic. But it does feel like all the stuff we got this week, right? The Fed minutes, the jobs report, it is kind of telling the same story. It's certainly what we've seen in the Treasury market.
Yeah, it's telling the same story. It'll be interesting to see next week what happens, because, of course, you get the CPI data, 7.1% is what people are looking for. Don't forget we get that PPI data as well, which is also going to be pretty high. Something like 10%, I think, is what economists are looking for on that level. We get retail sales. And then, of course, you got Powell on the Hill. So I know it's a confirmation hearing, but he's going to be peppered with a lot of questions about inflation, the labor market, and everything in between.
I was going to say that before you get a lot of that data next week, we're going to hear from Fed Chair Powell for that confirmation hearing. Caroline, what's the question that you would ask the Fed Chair?
I won't go funny on this. I'll go serious.
Yeah, no, I'm seriously.
Serious. I think it's inequality in the labor market.
Yeah.
Does that still matter when you're faced by inflation that also erodes the spending power of those who are the least socially, economically advantaged?
I thought it was interesting, too. I mean, we saw the unemployment rate go down, but then you look at the black unemployment rate go up, and you saw some metrics for women go up as well, and you wonder if Powell is going to address that. Does it matter as much anymore as it did, say, a year ago when he was talking about this?
Well, and when it definitely always matters, but as Caroline was saying, in the face of 6.8, maybe soon to be 7.1% inflation, if the wage gains, and it's been interesting, some of the people we've been speaking to say that the wage gains are higher than what's actually being reported here, and that's good news. But if it's not keeping up with inflation, the real wage is negative.
Well, and I'm just thinking about with Powell, like when is black unemployment, or minority unemployment not a priority anymore? Like how can you make it say, and for many months?
Maybe I should rephrase that. When inflation becomes more of a priority, you sort of push that to the side in favor of fighting what at least for right now is a pretty high inflation.
Well, it's an important conversation. I'm sure we'll hear more about it next week. Guys, have a great weekend.
Yeah, you too. Enjoy
week
the snow.
All of you, and the French fries. All right, that's going to do it for Beyond the Bell. Our cross-platform coverage, our market wrap coverage, what a week it was. We'll catch you same time, same place on Monday.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Carol Masser, Tim Stenovic. Let's get a check of the latest world and national news. For that, we go down Nancy Lyons, who's standing by in Washington, D.C. Hey there, Nance.
Thanks, Tim. President Biden says his economic plan is working after today's jobs report showing the U.S. economy added a record 6.4 million jobs in 2021, rebounding strongly from unprecedented losses in 2020 caused by the pandemic. He's also addressing what's being called the Great Resignation.
Americans are moving up to better jobs, with better pay, with better benefits. That's why they're quitting their jobs.
Biden renewed his call for lawmakers to pass his roughly $2 trillion tax and social spending plan. The Supreme Court is considering whether to allow the Biden administration's vaccine mandate to hold on large employers. Attorney Scott Keller, representing the National Federation of Independent Business, says it's a sign of government overreach.
A single federal agency tasked with occupational standards cannot commandeer businesses economy-wide into becoming de facto public health agencies.
Justice Elena Kagan questioned Keller about whether the grave risks posed by the current pandemic are reason enough for such a requirement. 3 white men who chased and killed Ahmaud Arbery have been sentenced to life in prison, with the judge denying any chance of parole for the father and son who armed themselves and initiated the deadly pursuit of the 25-year-old black man. Judge Timothy Walmsley says Travis and Greg McMichael were callous in their actions.
Today demonstrates that everybody is accountable to the rule of law. Taking the law into your own hands is a dangerous endeavor.
Walmsley says William Roddy Bryan, who recorded the incident, will have the chance of parole. Global news 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nancy Lyons, thank you so much. You're listening to Bloomberg Business Week. Carol Masser along with Tim Stenovic.
That's me.
You talked a lot about cryptocurrencies this week. And I know we've got Bitcoin, what was it, a drop of about 40% from its record. It can be volatile. It is volatile. It's curious. I guess we're near our lowest level since September. And how do we see it? We had a great conversations earlier. It does feel like it's becoming, or did this year, a lot more legitimate. I don't know. What are some of the conversations you have been having over on Quick Take?
Yeah, so a lot of the conversations that we've had in recent days have had to do with technicals and levels to look for Bitcoin. So, dollar amounts like 40,000 or 39,000 or even down to 30,000 because that was such an important number back in July when it hit those lows for the last year back in July and then bounced up and a few months later was at close to $68,000.
Right.
But it's tough because it's hard to find actual news, at least from a narrative perspective, that moves Bitcoin. It's turning into something that seems to be more correlated to, risk off and risk on than it was previously thought to be, I think.
It's interesting. One of the most read stories in this first week of 2022 is one about how billionaires are turning to crypto just in case money goes to hell. And it talks about Thomas Peterfee,
yeah.
Right?
I saw that.
Says it's prudent to have some crypto while Ray Dalio views it as an alternative to cash. I mean, who knows how much their exposure is, but it's interesting to hear these individuals involved.
Okay, so I don't want to start pop quizzing you, but what do you think Bitcoin's increase or decrease was in the last year?
300%?
No, 5.5%.
Oh, so little.
So little, but so volatile. That's going to be a big part of the conversation moving forward.
All right, yeah. It's got to kind of calm down, I think, before it becomes even really more legitimate. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We have wrapped up the first trading week of 2022, and the S&P posted its worst start to a year since 2016. Stocks lower today amid concern the Fed will be forced to raise rates faster than some investors had anticipated. The S&P 500 index dropped 19 today to end the week at 4677, a drop of 0.4%. For the week, the S&P was down 1.9%. The Dow lower by 4 points. Late day fade there, little change, but still down 4 points. We had NASDAQ down 145 points, lower by 1%. 10-year 1.76%, 10-year down 13.30 seconds. Spot gold up 0.2%, $17.95 the ounce, and West Texas Intermediate crude down 0.6%, $78.98 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much for that update. Well, among the most read stories on the Bloomberg, it's also the Bloomberg Big Take today. It's about Wall Street's eye-buying spree, and it's eating up those starter homes, Tim.
Noah Buheier joins us now. He's one of the bylines on today's Big Take, along with Patrick Clark and Jordan Holman. Noah, great to have you with us this afternoon. So when we think of iBuying, oftentimes I think a lot of people think of Zillow. How is what Zillow did or tried to do, because we should say tried to do, how did that affect the way that people entering the housing market actually have access to these homes?
Yeah, it's a great question. Thanks for having me on. So what my colleagues and I did was we took a look at more than 100,000 property records across the U.S. And these were records that related to sales and purchases that Zillow and the two other biggest iBuyers, OfferPad and Open Door, did last year. And we tried to get a sense of two things. One, where this was happening, and the sort of market concentration, and when they were flipping these homes, who the ultimate buyers were. And what we really found is that while these are still relatively small but fast-growing businesses, they're really concentrating their activity in a couple of markets. They're predominantly in the Sun Belt, like Phoenix and Atlanta and Charlotte. And what you find when you look at the property records is that in some of these markets where they're flipping homes, they're flipping a pretty staggering number of them to big investors, primarily, Wall Street-backed landlords that are buying and renting out single-family homes.
So help me out here, because I've, Noah, there's lots of stories I know of people, colleagues, where they say, hey, I'm selling a home, or the folks across the street just sold a home and they got 17 offers. How likely is it that one of those offers was one of these iBuyers?
What typically happens is that people approach the iBuyers if they don't want to list their home. They don't want to go through that process of having to weigh 17 different offers. It's been really popular in the pandemic. People don't necessarily want people in and out of their homes to do an open house. And it's really pitched as sort of a turnkey solution. What we were most focused on is what happens next, right? The iBuyer, someone sells to an iBuyer, but who does the iBuyer turn around and sell it to? And a good portion of the time, they're just, Zillow and Open Door and OfferPad, they're listing on the open market, and average people can buy. But they're also siphoning off a good number of those properties for investors to bid on. And if you look closely, some of those properties are never even hitting the market. They're being marketed directly to institutional buyers.
No, I'm wondering if you think we're going to start to see any sort of, I don't know, I don't want to use the term regulatory involvement, but state and local officials starting to get involved here. It makes me think of what happened during the early years of Airbnb, when people would start to buy units just for the purpose of Airbnb. And it's still come under a lot of scrutiny up to this day, but you saw a handful of cities around the country and the world trying to limit that in order not to reduce housing stock for people who actually lived in those places.
Yeah, it's a good question. Look, I can't speculate on what regulators are going to do. One thing I will say is that this is still a relatively small but growing phenomenon. But in some markets like Atlanta, there was one zip code we looked at that had more than 100 iBuyer sales last year, and about 70% of those went to investors. You also have to understand that this is mixed in with other investor purchases in these areas. And so I think you're right. There is a lot of angst out there about the role that big investors are playing in the housing market right now, in part because the kinds of properties that they're targeting are often the ones that are most accessible to people who are just trying to get a toehold in the market. They're more affordably priced homes. They tend to be in good school districts and in really desirable areas. Now, the rental companies will say that they're also doing important work by providing options for people who can't afford a down payment. So it's really quite a nuanced issue. But what I think was surprising from our analysis was just that there is this pipeline from these tech firms to big Wall Street-backed landlords.
Hey, to be fair, I mean, I think you've reached out to KKR, you guys, and you're reporting, and a few other firms. What do they all say about what they're doing?
Yeah, it's interesting. Cerberus, which is one of the firms we mentioned, said that this channel, the iBuyers, are a very small fraction of how they've gone about buying homes. We heard similar things from some of the other institutional landlords. Blackstone told us that their direct subsidiaries don't purchase homes from the iBuyers off market, though they have a small stake in Tricon, which is a big single-family landlord that has bought a lot of homes from the iBuyers.
Hey, Noah, remind us what went wrong with Zillow's attempt at iBuying?
Yeah, so previous reporting by Patrick Clark and me and some others at Bloomberg really showed that they had algorithms that were estimating how much they would pay someone to buy a house. And there was not necessarily something wrong with the algorithms, but the way that they were making offers ended up being a little bit too aggressive. And as they got into the fall, they realized that they had agreed to pay more for homes than they thought they were going to be able to turn around and sell them for. And so that, plus a confluence of other factors, led them to decide in early November that they were going to exit this business that they had made a big effort to get into and spent lots and lots of money to establish over the last couple of years.
Noah Buhire with today's Big Take. Wall Street's iBuying spree is eating up starter homes. Check it out at Bloomberg.com and on the Bloomberg terminal. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
So we are so lucky that we have incredible guests that come on and join us and give us a bunch of their time. And there are those that have seen a lot in the world, and I would put our next guest in that camp. And this is why we love to get his view on so many different things.
Yeah, we're talking about Alan Patrickoff, chairman of Graycroft and co-founder of Primetime Partners. He's going to be joining us in just a few minutes. He's also got a new book coming out, so we're looking forward to chatting about that.
That is life in VC, so hopefully we'll get to that as well. First up, though, let's sum up the trading day, the trading week. I'm already exhausted, Charlie.
Yeah, exactly. First trading week of the new year. Red on the screen. What happened to the Dow? It was higher for much of the session. Late day fade ended with a loss of 4 points today, down less than 0.1%. Key takeaway here, losing week for the Dow, the S&P, NASDAQ 100 index, and the Russell 2000. Red on the screen as we kick off the new year here. S&P down 19 today, dropped there of 0.4%. NASDAQ Composite Index down 145 points, lower by 1% today. NASDAQ 100 Index down 1.1%. 10-year yield 1.76% on the 10-year right now. Spot gold up 0.2%, $17.95 the ounce. Crude down 0.7, $78.80 a barrel on WTI. So stocks fell amid concern the Federal Reserve will be forced to raise rates faster than some investors had anticipated. Cliff Corso is president and chief investment officer at Advisor Asset Management. He was our guest right here on Bloomberg Business Week.
Fed's got a really tough job here and a tough challenge because I think that, they really clearly want to speed up their reaction function, given inflation figures. We saw that with the pulling forward of the tapering. But they're trying to do this without creating undue volatility like we saw during the taper tantrum of 2013.
And again, 10-year yield right now, 1.76%. Jab or job at Citigroup. Citigroup was the first major Wall Street bank to impose a strict vaccine mandate. Now it'll be placing office workers who don't comply by January 14th on unpaid leave. Citigroup higher today along with other bank stocks. Citigroup up by 1.3%. Banks report earnings next week, including JP Morgan Chase and Wells Fargo. JP Morgan Chase up 1% today. Wells Fargo up 2.1%. And that's a Bloomberg Business Flash.
Certainly is. Thank you so much, Charlie Pellet. You're listening to Bloomberg Business Week. Carl Master along with Tim Stenovic. What we do love our guests and those that come on with us, some of them especially so for their ability and willingness to go a lot of places with us from an informed vantage point. Politics, economy, investing, so much more. One of those individuals is Alan Patrickoff. He's an early venture capitalist. He helped build and grow such companies as America Online, Office Depot, Apple, so many. He's Chairman Emeritus, co-founder of Graycroft Ventures. He's also co-founder of Primetime Partners, and he joins us once again, this time around on the phone in New York City. Alan, Happy New Year. Nice to have you back with us. How are you?
I'm fine. COVID-free, thank you.
Well, good to hear, because it's a little crazy, certainly, as we go out and about in this world. Lot going on this year already, and we want to get into a couple of things. But first of all, you look out at this environment. You do have a great vantage point. You see what's going on in the world of VC and the startup world. How does this year look to you?
Well, we're coming off a period of euphoria as we ended 2021, and I don't see that diminishing, certainly in the near term. There's a lot of money washing around in the institutional market in particular, and venture performance has been exceptional in the past 12 to 24 months. So everybody is feeling quite euphoric, and I don't see anything that's going to change that other than a surprise. And I've been in this investment business long enough to know that surprises, which are what they are called, a surprise, is the one thing that kind of shakes everybody. Venture is not affected by interest rates. It really isn't affected by inflation because all these companies we invest in are so early on that they kind of can override that with their growth trends.
So where are you seeing areas of interest for 2022, and where are you seeing areas of focus, at least for venture capital funding? If it is going to be another big year for venture, if it is going to be another big year for investments and returns, where's that going to happen specifically?
Well, selfishly, you know, I've started in the last 18 months a new firm called Primetime Partners, which is focused on an area that virtually was a white space, which is anything that serves the what I call the ageless community, which is enormous and getting bigger and will be the largest part of the population by 2030, growing faster with more money, and the older generation is living longer. And there are so many things that they need specifically in terms of products, services, technologies, experiences, and it's not the same as the millennial generation, where most of the focus in venture has been. But I see that as an increasing trend. We kind of had a little bit of it to ourselves in the beginning, but I can see already that others are encroaching on the area, and they're not names you would recognize because they're all relatively early. But I think over the next year or two, you're going to hear names like a place called Mom, which is the one perhaps that's known. But it's an increasing trend. So that's my focus on Primetime. In terms of Graycroft, we continue to be interested in fintech. There's been a lot of interest in every form of new kind of neo-banking. Any place that people can buy money. We have a company called Public, which is, I hate to compare it, but similar to Robinhood in the sense that you can buy in very small fractional interests. And payment systems are increasing all the time. We have a company that's dealing in Africa called Flutterwave, which seems to have no end. It's like the square of Africa, and growth has been enormous. So fintech is a big area of investment.
So we've got about a minute, and then we'll do some news and then come back. But one of the things you talked about, surprises, in terms of how the tax policy might change out of Washington. Could that be a surprise that could dampen the VC world? And we've got about 40 seconds, then we'll come back and talk some more about it, Alan.
Well, I'm sure you're referring to QSBS, which is a existing policy called Qualified Small Business Companies, which is eligible to any company that has raised less than $50 million and where investors hold it for more than 5 years, which has been a great boon to startup companies, particularly the founders and their early employees, as well as the investors. And it could be set back by the Build Back Better plan of the president, not intentionally, but as an incidental consequence of changing the tax laws.
Hey, sit tight, because I know last time you were on, we talked a little bit about this. We'll dig a little bit deeper into it and your concerns and maybe how we could approach it differently. We're going to come back with Alan Patrickoff, Chairman Emeritus, co-founder of Graycroft. He is co-founder of Primetime Partners. He's with us on the phone in New York City, and we'll continue that conversation in just a moment.
In the meantime, let's head down to Washington, D.C., where we're going to check in with Nancy Lyons. She's standing by with the latest world and national news. Hey there, Nance.
Thanks, Tim. The 3 white men convicted of killing black jogger Ahmaud Arbery have all received life in prison. Only one, Roddy Bryan, who recorded the incident, has the chance for parole. Testifying ahead of the judge's decision today, Arbery's mother, Wanda Cooper Jones, asked the judge to impose the maximum sentence for all 3.
Ahmaud never said a word to them. He never threatened them. He just wanted to be left alone.
Judge Timothy Walmsley says it was clear Arbery was hunted down and shot in a disturbing scene. All 3 defendants plan to appeal their conviction. The first black man to win the Oscar for Best Actor has died. The Bahamian Minister of Foreign Affairs confirmed that actor Sidney Poitier has died at the age of 94. He won the Academy Award for Best Actor in a leading role for Lilies of the Field. Poitier also received critical acclaim for playing a black doctor engaged to a white woman in Guess Who's Coming to Dinner, starring opposite Katharine Hepburn.
Dr. Prentice, I'm so pleased to meet you.
I'm pleased to meet you, Mrs. Drayton. I take it Joanna's already busted out with the big news.
Well, she has told me a good deal, and all very quickly, too.
Poitier died in his native Bahamas, with the deputy prime minister there calling him a national treasure. A public memorial service for legendary football coach John Madden will be held next month. The NFL says it will take place February 15th in Oakland, California. The league says more details will come out later. Global news 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, thank you so much, Nancy. We are Carol Massar, Tim Stanovic, right here on Bloomberg Business Week. And our guest right now, Alan Patrickoff of Graycroft, of course, the co-founder. He's also co-founder of Primetime Partners, with us on the phone in New York City. Alan, we have about a minute and a half, and then we'll come back and talk some more. What I just wanted to ask you here, you mentioned earlier for our global audience about how there's a lot of money sloshing around. That money sloshing around can go into some really great, interesting places. Is there any concern that some of that money is going to go into places that is bidding up areas that are going to make no sense in years to come? And I don't know whether it could be crypto, NFTs, SPACs. Just curious what you think. I just got about a minute or so.
Well, you're bringing up the controversy that always exists, is whether there's too much money chasing too few deals.
Mm-hmm.
I think that we have a lot of large-sized funds, without naming anyone in particular, but which are hedge funds or large growth funds. When you see funds that are being raised at $10 and $20 billion and trying to put money to work in the later stages of growth companies, inevitably you're seeing bigger demand and just a limited supply of companies that can absorb that kind of capital. So they're going to be excessive. I don't think you could translate that specifically to crypto or NFTs, which are, each one has its own area of focus. The NFTs is the latest on the horizon, and I think there's a lot of interest, and I think it will sort itself over time. And by the way, that also is affected by the blockchain and the ability to transfer funds in a different fashion than they have in the past, and NFTs will benefit from it. So in terms of crypto, I think everyone wants to play in the and thinks that crypto could ultimately the new currency of standard of value. Who knows?
Alan Patrickoff, we're going to come back with you more on Bloomberg Business Week. You are listening to Bloomberg Radio. This is Bloomberg.
facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Down Friday, the S&P posting its worst start to a new year since 2016 amid concern the Fed will be forced to raise rates faster than some investors had anticipated. Today, we're looking at the 10-year at 1.76%, 10-year down 12/30 seconds. S&P lower by 19 points today, down 0.4%. Again, for the week, the S&P dropped by 1.9%, and by implication, year to date. The Dow down 4 points today, lower little change. Late day fade there. We had NASDAQ down 145, down by 1%. NASDAQ 100 index down 1.1%. Spot gold up 0.3%, $17.96 the ounce. West Texas Intermediate crude down 0.7%, $78.88 a barrel. Briefly, PayPal Holdings exploring the launch of its own stable coin as part of its cryptocurrency push. This according to the company. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I want to get right back to Alan Patrickoff. He's Chairman Emeritus, co-founder of Graycroft, co-founder of Primetime Partners, with us still on on the phone in New York City. So, Alan, we were talking about the qualified small business stock, or QSBS. Tell us a little bit more about. I know we've talked about it with you before. There's been a lot written about it. Times has called it a lavish tax dodge for the ultra wealthy, and how you can easily multiply it by giving shares in a startup to family members and so on and so forth. You say it's an important thing that we need to have.
Well, it's interesting. I had a follow-up call with the people who wrote that article for the Times, and pointed out the fact that I think they may have found some isolated incidents where the code was abused, but basically what is really being forgotten is the people who are the primary beneficiaries of QSBS are the founders, and the founders who have nothing, let's assume, when they're starting out a company, even the company they mentioned, which was Roblox, which is gigantic today, but when it started, there was nothing, and if the founder gave shares to his children or put things in trust, he was doing what wealthy people do, which is doing estate planning at a time when it had advantages for he and his family. And why shouldn't they have the same benefit that more wealthy people have? And so this gives the opportunities for startups and their investors and their young founders to be able to do estate planning right from the get-go and benefit family members. And it's an appropriate thing for, even I'm sure you do it, and I'm sure I do it. You create a trust for your children as you're gaining your activities in your life. And so this is a very valuable resource. It's been a big incentive for companies to raise money for startups. And as I was saying before, for the first 5 or 6 years, it wasn't really actively employed. This has been around since 1993.
Right.
It's only in the last 5, 6, 7 years that the rules were changed to make it more attractive, that it actually is being used actively. And so to take it away would be a shame for founders as well as for investors.
Well, I'm wondering then if one of the reasons that the Biden administration wants to actually close this loophole or tax dodge, or call it tax break, call it what you will.
Not a tax dodge. It is not a loophole. It's a feature in the tax code that's been there since 1993.
So if they do want to get rid of that in order to make more revenue and bring in more revenue, what would be a better way to bring in revenue? What are other areas of the tax code that should be changed if this one shouldn't be?
Well, you bring up a sore point, but I contrasted the fact that QSBS and President Biden himself wants to stimulate formation of young new companies and create more entrepreneurs. On the other hand, you have the carried interest feature, which is a beneficiary. I am a beneficiary of, and anyone who runs a fund who's participating in carried interest, where it's taxed at capital gains rate. And it has been proposed almost every time there's a tax bill to make it more ordinary income, which it is, which is part of the earnings that people do who manage funds. And every time that gets put aside, and all of a sudden an alternative revenue source develops, which is to reduce QSBS benefits. It seems like a bad trade, in my opinion, but and frankly, I think carried interest would produce more income by changing that feature than they will gain from changing the QSDS area. But it's the government. Look, let's face it, the government is looking for any source of revenues now to offset the cost of BBB, and I'm sure there are lots of other places they can get money. It's a shame that they have picked on this one as one of many things that are being changed.
Hey, Alan, I hope we've got a few minutes left here, and I'd love to ask you a little bit about, you've got a book coming out in May, No Red Lights, Reflections on Life, 50 Years in Venture Capital and Never Driving Alone. Looking forward to it, and I hope when it comes out, you'll come on and talk to us about it. Tell us about why you wanted to write a book.
It's nice of you to ask. Actually, this is the first time anything about the book has actually been on the air in any form. So this is the first time because it was just released on Amazon for pre-order this week.
Yeah.
I've been asked for many years to write down things that have happened in my life, and because I've, being around in the business 50 years, actually I've been in the investment business 65 years. But being in the venture capital business 50 years, you become a legend just by living long enough, nothing more than that. And so I am a living legend. I used to be the founder of the venture industry, then I was the father of it, then I became the grandfather of it. Now I'm the legend. I don't know what the next stage I'll be the former. And so I spent the last year or two writing this, and I hope it'll be of interest to some people. It's really designed to, honestly, the real reason is I am 87. I just hired a track coach to try to run the marathon next November.
Wow.
And
good for you.
I live a very active life, as you announced my two affiliations, and I want to be an inspiration to people and say, if I can do it, I keep going at this stage, why can't you? This is my third, in effect, venture fund that I've been involved in. Apex being the first, Graycroft second, and now Primetime. And I like to be a role model for people who want to do it again and not just go play golf in Florida or sit home doing nothing and figure out what they're going to do that day. There's people over 60, I'm picking that age, have enormous opportunities today using their experience, using their Rolodex, and too many companies, I think, force retirement at too early a stage. And I think the opportunities to build these things, and just like I say, the opportunities with Primetime, we've invested in a company called Retirable, which helps people in retirement. We have another company called Tembo Health that does telemedicine for senior living facilities. Everything that you can think of is now available to invest in this area. So we want to back older entrepreneurs. We want to back younger entrepreneurs who are involved in helping people build their lives better.
I love it because we talk so much about diversity and inclusion, and think about a lot of older people out there, and I say that with incredible respect, who are spending money doing things, and I do think just like when we leave out minorities or women or LGBTQ, we're leaving behind really important parts of our population, and we're just smarter about everything when we include everyone. Anyway, Alan, always.
My partner Abby Levy and I really are totally focused on becoming thought leaders in this area because it does need proselytizing, and I think we're accomplishing something in the last year and a half.
Alan, be well. We're going to check in with you again, we know, in the future. Alan Patrickoff there. What a week. What a day. For Tim Stanovic and the whole Bloomberg Business Week team, folks, have a great weekend.